after the Federal Reserve's decision yesterday to leave a measure of support in place. 10-year prices soared, yields dropped to an 18-month low. Some bond investors wonder if and where you can find any value left in the market. Ira Jersey is with us now. He is from Credit Suisse. He is a director within the interest rate strategy team. Ira, so glad you stopped by in the newsroom. So the Fed left this pledge, to keep rates low for an extended period of time. Should investors just stay on the shorter end of the yield curve and hope for the best? I mean, what other choices do they have?
Well, that's an interesting question, because we do actually think that twos will trade down to about 40 basis points just based on funding, based on the Fed's going to be on hold for at least the next 2 years, and yesterday's move makes it just all the more apparent to us. From a total return perspective, we really like the belly of the curve, so the 4, 5, 6 year area of the curve. That's especially true because that's where the Fed has room to buy. The Federal Reserve can only purchase 35% of every Treasury bond, every individual bond, and they own a lot of 10 to 15-year bonds.
Seem like they should be maxed out there.
Right. So it's these new bonds kind of in the 4 to 7 year sector where they really have the room, and we think that will outperform. In fact, we might have a graphic of this, but if you look at how 5-year bonds have performed against 2-year and 10-year bonds, we call that the 2s, 5s, 10s butterfly. 5s are at the lowest level that they've been in at least 2 decades.
All right, well, we do have that graphic up now, so people can actually see that comparison between the 2, the 5, and the 10. And
this doesn't mean that 5s are expensive, because 5s can go much further. If you look at an experience that, for example, what happened in Japan, 5s can get very, very low. So if you look at the 2-year note versus the 5-year note, historically speaking, that's still reasonably steep yield curve, and that could get much flatter as the Fed remains on hold and the economy remains weak.
So going back to the decision and the moves, I mean, were you surprised at all? I mean, in some ways, I feel like the Fed did telegraph. I mean, there were a few editorials, there were a few even print press pieces, but yet then there was that speech 10 days ago, and it was everything's coming up roses, but no indication that the Fed was as worried as it is, apparently.
Well, it's interesting. Going into this meeting, it was the most mixed reaction from clients and I think from other analysts. We were thinking that they wouldn't do anything, primarily because doing the asset purchases the way that they're doing it probably won't help the real economy in the long run.
But what other choice do they have?
Correct. And that being said, I think the fear was that if they let the mortgages and agency portfolio run down, that would reduce bank liquidity. So that so basically your excess reserves, the amount of money that banks have available to them to lend, will do it. We don't think it's going to work, primarily because the problem's not banks not wanting to lend at this point. Banks have tons of money to lend. What they don't have are people who want to borrow that money.
Well, right. If you don't have a job, you're not going to take on additional debt.
Correct.
So does this just point it's all about jobs then?
A big part of it's jobs. I think a big part of this is just time. We're an impatient people. We want everything to be wrapped up in a 1-hour docudrama and have everything explained to us by the epilogue. The problem is that we went through a very big levering up of our country, and it's going to take a long time to delever it. And it's happening, but it's going to take another 2-3 years in order to get back to a place where politicians and policymakers are comfortable.
So basically, this is proof that the Fed's exit strategy is going to be a little trickier than we all thought.
Absolutely.
Ira Jersey, thank you very much. Ira Jersey joining us there from Credit Suisse.